It's a few reasons. First and foremost, it's diversification. You're moving away from home markets into a much broader portfolio of over 300 names spread across the globe. Two, these are just much larger businesses. The median revenue for names in our portfolio is over $6 billion, and the median earnings is over $1 billion. When you compare that with ASX 200 listed companies, they're substantially larger. This is not one to replace what people have in current portfolios, but we feel it's a good diversifier away from local markets. It's a chart showing a few different things and then comparing it to local alternatives. First, from a yield perspective, the global high yield market has over 6% yield, which we think is quite additive to portfolios. Two, over the last 10 years, from a total return perspective, it's matched that of local equities. Three, from a volatility perspective, it's had 40% less volatility than equities. So when you think about that, first, it has a higher income. It's had almost the same return over 10 years, but with 40% less volatility. We think that's very attractive. And fourth, it's its performance during the global financial crisis. If you were invested in high yield at the beginning of 2008, by the end of 2009, you were up almost 20%. There's almost no other asset classes in the world that match that. Because what you generally find for high yield is when you do have drawdowns, it's a very sharp snapback up. And we saw that during the global financial crisis, and we saw that actually at the end of 2018 and the beginning of 2019, where the market was down almost 4% in Q4 of 2018 and roared back within the first 2 months of 2019.